Hi, Don Johnson with the Don Johnson Real Estate Team at Keller Williams in Cary, North Carolina, and thank you for joining me today for my weekly housing update. I'm going to review an interesting article I read from Henry McVey with Kohlberg, Kravis, and Roberts. Henry provides a very good argument for his review of the housing crisis and what he expects, or how he expects the economy to unfold as a result of the economic crisis, and in particularly what's going to happen with the housing market. So here are 5 conclusions that Henry offers from his research. First, the cyclical upswing in the housing market that typically accompanied the economic downturn that we experienced back in 2007 did not happen compared to other economic downturns. For example, in 2001, in 1991, and in 1980, after those downturns, the economy saw a 19% increase in GDP. However, in 2007 or 2009, once we got through the bad part, the really bad part of the downturn, we only saw a 3% increase in GDP. And number 2, housing starts, and this is a good thing, housing starts have bottomed and are running at historically low levels. So Henry expects the new homes to come online in 2012 to the tune of 750,000 units. In 2013, 850,000 new homes. And in 2014, an additional 1 million homes coming online. So those are some pretty good numbers relative to our historical trends over the last few years. He also expects the housing market to contribute 30,000 monthly jobs. So that's a big number and will contribute to the GDP, gross domestic product, by 25 to 50 basis points. So that's an astounding increase compared to 2000 and 2010, when the lack of a housing market and the lack of jobs was a drag on the economy by 125 basis points. So a nice swing there. Number 3, not necessarily good news. The uptick in new construction will not materially increase the prices for existing homes. And for this reason, he indicates that there are 6.4 million hidden homes on the market today. Some need to be sold, taken off the market. Others need to be dealt with in terms of the financial delinquency or the mortgage delinquency issue. He estimates that 4.1 million or 8.15% of the 50.3 million mortgages are delinquent. So that compares to a historical average of 4.7%. We're currently at an 8.15% number. So a big issue there that may impact existing home values. Number 4, based on the impacts or effects of increasing existing homes or increasing new homes coming online and job increases, he expects a 0.4% increase in real GDP to what he forecasts to be an annual GDP of 2.3%. So the job growth as a result of the new homes coming online, he expects that to have a benefit to GDP growth. He also expects, number 5, he expects investors will plow money into the home rental business since the diminishing carrying cost of ownership and the robust pricing of rental apartments is too wide at this point. So that gap's going to push people into a home rental business. He also indicates that some of the new initiatives by the FHFA, the Federal Housing Finance Agency, have helped to offset that gap to some degree, or will. And I'll discuss those in upcoming videos. He expects home building companies to see earnings rebounding. So if you're investing in home building companies, your Home Depots and Lowe's, of course with new homes, the demand for building materials will increase. Finally, home appreciation will be minimal over the next few years, which implies consumers will not experience significant increase in net worth. So consumers will continue to pursue value pricing or value items, such as private label goods and discount clothing. So my interpretation of McVey's research and how it applies to Wake County and Cary and Raleigh and Durham, Chapel Hill markets, it's still a buyer's market. So those buyers are looking for value properties. If you're not priced correctly, your home is not going to sell. It's going to stay on the market. There's just too much inventory at this point. Maybe not as much as Florida or Arizona or some other states in the United States, but we do have our share of excess inventory for both just overpriced homes sitting on the market as well as distressed properties. How many we know, in terms of distressed properties, we're not sure about that, but we do see the average selling time indicating it's a buyer's market. So if you don't need to sell, I'd hang on and maybe you can see some appreciation. If you do need to sell, I would encourage you to get it on the market now ahead of the shadow inventory that may be coming online. But the bottom line overall is good news. We've shifted from an economy where the housing was causing a 125 basis point drag on GDP to one where we're seeing a positive 25 to 50 basis point improvement to GDP. So that's a good thing. Thank you for joining me, and I look forward to talking to you again in future updates. And if you need any help buying, selling, or investing in real estate, I look forward to having a conversation with you.